There's a number that should terrify every person holding paper currency right now. $318 trillion. That's not the US debt. That's not China's debt. That's the total debt of the entire planet. Every government, every corporation, every household combined. And here's what makes your stomach drop. The entire global economy, everything humanity produces in a single year, is worth about $105 trillion. We owe 3 times more than we make. 3 times. And while this mathematical impossibility builds toward collapse, silver is trading at $32 per ounce. Not $320, not $3,200, $32. You want to understand why that's insane? Because we've watched this exact scenario play out across human history. Not once, not twice. 17 times in major civilizations. And every single time, the sequence is identical. The debt becomes unpayable, the currency collapses, and the people holding physical precious metals are the only ones who survive financially intact. Right now, we're not approaching this pattern. We're deep inside it. Stage 4 of a 5-stage collapse that is executed with mechanical precision for 3,000 years. And silver, the most undervalued hard asset on Earth, is about to reprice violently. Not because of speculation, not because of hype, because mathematics demands it, because history demands it, because $318 trillion in debt against $105 trillion in production cannot exist. Something has to give. And when it does, silver will not go up gradually. It will explode. Let me show you why this is inevitable. Let me show you the pattern that never fails. Let me show you why you have maybe 12 months to position yourself before the window closes permanently. Before we get into the current crisis, you need to understand the machine, not the economic theory, not the policy explanations, the actual mechanism that has destroyed every major currency in human history. It's simple, almost offensively simple, and that's why most people refuse to believe it could bring down the modern financial system. But simplicity doesn't make it less lethal. Stage 1. A nation starts with sound money, coins made of gold or silver, currency backed by something real, something you can hold, something that cannot be created by decree. This creates trust. Merchants accept payment because the coins have intrinsic value. Trade flourishes. The economy grows. Wealth accumulates. This is stability. This is how civilizations build. Stage 2. The government needs more money than it has. Maybe there's a war. Maybe there are social programs to fund. Maybe the leadership wants to stay in power by buying loyalty. So they start cheating. They reduce the precious metal content in coins while keeping the face value the same, or they print more paper than they have metal to back it up. They tell everyone the money is still good because the government guarantees it. And for a while, people believe them. The money supply expands while the real wealth behind it stays constant. This is the crime. This is where the trap is set. Stage 3. Prices start rising. The currency weakens. People notice something is wrong. The same coin buys less food. The same paper buys less land. Slowly, then suddenly, citizens start trading their government money for anything real. Commodities, property, gold, silver. The government panics. They need to cover their obligations. So they print more, issue more coins, create more currency. This accelerates the problem. Prices spiral upward. Trust evaporates. The social contract begins to fracture. This is the crisis point. This is where societies break. Stage 4. The currency dies, sometimes fast, sometimes over decades, but it always dies. Hyperinflation destroys purchasing power. Or the government is forced to introduce a completely new currency, often backed by hard assets again. There's a reset. Wealth is transferred from those holding paper to those holding real assets. And often, the regime itself collapses. Governments fall, empires end, new orders emerge. Stage 5. The cycle begins again. Because humans forget. Because new generations believe their system is different. Because every civilization thinks they've solved the problem that destroyed their predecessors. This pattern has executed 17 times across major civilizations in recorded history. Rome, Byzantium, Song Dynasty China, medieval France, Spain, the Ottoman Empire, Weimar Germany, Zimbabwe, Venezuela. The list is long and consistent, and every time, the same 4 assets preserved wealth: land, gold, silver, and productive businesses. Paper currency holders lost everything, every single time. Now let me show you 3 examples where this pattern executed with perfect precision. Because if you understand these, you'll understand why what's happening right now is not unique. It's scripted. Rome, 64 AD. Emperor Nero has a crisis. The Great Fire of Rome just destroyed 2/3 of the city. Reconstruction costs are astronomical. He's fighting expensive wars against Parthia. There are civil conflicts. The Jewish revolt is draining the treasury. And Rome's silver mines in Spain cannot keep up with expenditure. The Roman currency, the denarius, had been roughly 95% pure silver since Emperor Augustus established the standard. It was trusted across the empire. Merchants from Britain to Egypt accepted it. It was real money. Nero makes a decision. He reduces the silver content to 80%. Same coin, same face value, less silver. This lets him mint more coins from the same amount of metal. Problem solved. Except he just set a precedent that would destroy the empire. His successors see what he did, and they do it again and again. Emperor Septimius Severus, in 197 AD, wants to keep his soldiers loyal. Military pay is expensive, so he doubles their wages, but he can't afford it with the existing money supply. The denarius drops to 46% silver. His son Caracalla goes further. In 215 AD, he introduces a new coin called the Antoninianus. It's supposed to be worth 2 denarii, but it only contains 1.5 times the silver. Instant profit for the government. Instant debasement. By the time Emperor Gallienus rules in the 260s, the silver content has collapsed to 5%. What was once a respected silver coin is now a bronze token with a thin silver wash. The paint comes off if you rub it. What happens to the economy? The price of grain triples within 20 years. Soldiers refuse to accept the debased coins as payment. They demand goods instead. Food, weapons, land. The economy partially reverts to barter. People hoard the old coins with real silver content. Gresham's law takes effect. Bad money drives good money out of circulation. Trade contracts. The empire fragments. By 301 AD, Emperor Diocletian tries to fix the problem with price controls. He issues an edict setting maximum prices for over 1,000 goods. The penalty for violating these prices is death. It doesn't work. It never works. You cannot legislate economic reality. By 310 AD, Emperor Constantine is forced to create an entirely new currency system based on a gold coin called the solidus. The old denarius is worthless. You need millions of them to equal 1 solidus. The wealth transfer is complete. Anyone holding the old coins lost everything. Anyone who had converted to land or precious metals survived. That's the pattern. All 5 stages. And Rome was the dominant superpower for 600 years. The most advanced civilization of its time. It didn't matter. The mathematics won. Weimar Germany. 1914 to 1923. When World War I starts, Germany abandons the gold standard. The government is certain the war will be short. They believe the losers will pay for everything. They're wrong on both counts. Germany loses. The Treaty of Versailles imposes 132 billion gold marks in reparations. In today's purchasing power, that's over 500 billion. The annual payments consume 25% of Germany's entire GDP. It's economically impossible, but they try. The new Weimar Republic government wants to keep citizens happy. They want to rebuild infrastructure. They want social programs. They want to avoid political instability. Tax revenue covers 37% of government spending. The rest has to be printed. Before 1914, Germany had a gold-backed mark. It was one of Europe's strongest currencies. Respected internationally. Stable. The foundation was real. Then the Reichsbank starts printing to pay for everything. In early 1922, it takes 160 marks to buy $1. That's bad, but manageable. Most Germans don't panic yet. By December 1922, it's 7,400 marks per dollar. That's a 46-fold devaluation in 10 months. The middle class starts to worry. Their savings are eroding. But the government says it's temporary. They say they have it under control. Then 1923 hits. France and Belgium invade the Ruhr industrial region to seize resources as payment. The German government supports a general strike. 2 million workers are told not to work. The government pays their wages with printed money. The printing press goes into absolute overdrive. June 1923, it's 109,000 marks per dollar. October, 25 billion marks per dollar. November 4th, 2 trillion marks per dollar. People are carrying wheelbarrows full of cash to buy a loaf of bread. A student sits in a cafe and orders coffee for 5,000 marks. Before he can order a second cup, the price has increased to 7,000 marks. 40% inflation in 30 minutes. Factory workers are paid twice a day, once in the morning, once at lunch, because their morning wages become worthless by afternoon. Their wives wait at the factory gates to take the cash immediately and run to stores before prices change again. Farmers stop selling food for paper. Why would they? The money is worthless by the time they get home. People in cities are starving. The middle class is annihilated. A lifetime of savings becomes worthless in months. People who own businesses, who had worked for decades, reduced to poverty overnight. The social fabric tears apart. November 15th, 1923, the government introduces the Rentenmark. 1 trillion old marks equals 1 new Rentenmark. The old currency is declared void. Everything resets. If you held paper marks, you lost everything. If you had converted to land, gold, silver, foreign currency, you survived. The psychological trauma from this collapse is so severe that within a decade, it helps bring Adolf Hitler to power. The Weimar hyperinflation is taught in economics classes as a cautionary tale, but the lesson isn't learned. Because we're doing it again, same pattern. All 5 stages. A country with some of the best engineers and scientists in the world couldn't stop it. The mathematics didn't care about German efficiency or technological advancement. United States, August 15th, 1971, to present. President Richard Nixon goes on television and makes an announcement. The United States will temporarily suspend the convertibility of the dollar into gold. Foreign governments can no longer exchange their dollars for gold at the Treasury window. The dollar had been pegged to gold at $35 per ounce since the Bretton Woods Agreement in 1944. Nixon says this is a temporary measure. He says it will stabilize the dollar and protect American jobs. The window never reopens. Before 1971, the post-World War II monetary system worked like this. The dollar was backed by gold. Other currencies were pegged to the dollar. This created stability. International trade flourished. Countries accumulated dollars because dollars were as good as gold. But by 1971, the United States has a problem. There are 4 times as many dollars circulating globally as there is gold to back them. The Federal Reserve has been printing to fund the Vietnam War, to pay for Great Society programs, to cover expanding government commitments. France figures this out. President Charles de Gaulle starts demanding gold for France's dollar holdings. Other countries follow. The gold is leaving Fort Knox. If this continues, the United States will run out of gold entirely. Nixon closes the window, and suddenly, for the first time in history, the global reserve currency is backed by nothing except government promises. After 1971, all constraints disappear. The 1970s bring stagflation, high inflation, low growth, unemployment, oil shocks. The dollar collapses against real assets. Gold goes from $35 per ounce in 1970 to $850 in January 1980. That's not gold appreciating. That's the dollar being exposed for what it became. Unbacked paper, but the printing never stops. 2008 financial crisis, the Federal Reserve prints trillions. Quantitative easing, they buy government bonds with newly created money. 2020 COVID response, $6 trillion printed in 18 months. The money supply expands by 40% in a year and a half, the largest monetary expansion in American history. Today, U.S. national debt is $36.1 trillion. We're paying $892 billion per year just in interest. That's more than the defense budget, more than we spend on veterans, education, and infrastructure combined. Just interest. And by 2034, the Congressional Budget Office projects interest payments will hit $1.7 trillion annually. That's 5.4% of GDP, just to service existing debt, not to pay it down, just to keep up with interest. Here's what's happening structurally. Before 1971, when productivity increased, wages increased. The gains were distributed. Since 1971, productivity keeps rising, but real wages flatline. The wealth created goes to asset holders. The gap between the wealthy and everyone else explodes. In 1971, someone earning a median income could save and buy a house in 2.5 years. Today, over 7 years, in 1971, a year of college tuition cost the equivalent of working a part-time summer job. Today, it costs a year of full-time wages. Food costs more, energy costs more, healthcare costs more, housing costs more. Everything costs more in real terms. The middle class is being destroyed, not through policy failure, through currency debasement. And globally, trust is cracking. Central banks are diversifying away from dollar reserves. The BRICS nations are openly discussing alternatives. China and Russia are accumulating gold at record rates. The share of global reserves held in dollars has declined from 71% in 1999 to 59% today. We're in stage 4 right now. The currency isn't dead yet, but the crisis is building. The debt cannot be repaid, the interest cannot be sustained. And the only way out is to print more, which accelerates the collapse. So where does silver fit into this pattern? Throughout every currency collapse in human history, people flee to real assets, things that cannot be printed, things that cannot be debased, things that hold value regardless of government decree. For 5,000 years, gold and silver have been money, not because of tradition, not because of sentiment, because they possess the qualities money requires. They're scarce, they're durable, they're divisible, they're fungible, they're portable, and most importantly, they cannot be created out of thin air. When Rome's denarius collapsed, Roman citizens hoarded silver coins, the old ones with actual silver content. When Weimar marks became worthless, Germans traded for anything tangible: food, land, foreign currency, gold, silver. When every fiat currency has died, and they all die, precious metals survive. Gold is currently trading around $2,700 per ounce. Silver is at $32. That gives us a gold to silver ratio of roughly 84 to 1. Historically, that ratio averages between 15 to 1 and 60 to 1. During periods of monetary stability, it tends toward 50 to 1. During currency crises, it often tightens to 30 to 1 or lower. If the ratio simply returned to the long-term average of 50 to 1, with gold where it is now, silver would be trading at $54 per ounce. That's a 69% increase from current prices just to hit the historical mean. But here's what the pattern tells us. We're not in a normal market cycle. We're in a debt crisis, a currency crisis, a crisis of confidence in paper assets. In these environments, silver doesn't just catch up to gold gradually, it explodes. In 1979 to 1980, during the last major dollar crisis, silver went from $6 to $50 in 18 months. That's a 33% gain. The inflation-adjusted equivalent of that $50 peak would be $194 in today's dollars. We're trading at $32. In 2008 to 2011, during the financial crisis and subsequent money printing, silver went from $9 to $48, another 433% gain in 3 years. And here's what makes silver unique compared to gold. Gold is primarily a monetary metal. About 90% of gold demand comes from investment and central bank purchases. It's a pure store of value. Silver is different. Silver is both a monetary metal and an industrial metal. About 50% of silver demand comes from industrial uses: solar panels, electronics, batteries, electric vehicles, medical equipment, 5G infrastructure, water purification. The green energy transition alone requires massive amounts of silver. A single solar panel uses about 20 grams of silver. An electric vehicle uses between 25 and 50 grams. As the world electrifies, as solar deployment accelerates, industrial demand for silver is increasing structurally. But here's the critical point. The supply of silver is constrained. Most silver is produced as a byproduct of mining other metals: copper, lead, zinc. Only about 25% comes from primary silver mines. This means silver supply doesn't respond quickly to price increases. You can't just open more silver mines overnight. It takes years, a decade. And meanwhile, industrial demand is rising, investment demand is rising, and supply is relatively fixed. The setup is extraordinary. You have a metal that serves as both money and industrial commodity. You have supply constraints. You have rising industrial demand. You have $318 trillion in global debt that cannot be repaid. You have currency debasement accelerating. You have central banks printing without limit. You have the historical pattern screaming that we're in stage 4 of a currency collapse, and you have silver trading at $32 per ounce. Nowhere near its inflation-adjusted highs. Nowhere near its historical ratio to gold. Nowhere near where it should be given the fundamentals. The market is pricing silver as if nothing is wrong, as if this debt can somehow be managed, as if the pattern won't execute, as if this time is different. And that's what they always say. This time is different. We hear it from central bankers, from government officials, from mainstream economists. They say American exceptionalism protects us. They say the dollar's reserve currency status is permanent. They say modern monetary theory means debt doesn't matter. They say technological innovation changes the rules. They say our institutions are too strong to fail. They said similar things in Rome when it ruled the known world. The Roman Empire lasted 1,000 years. Surely the denarius would last forever. They said it in Weimar Germany, one of the most advanced societies of its era. Germany had the best scientists, engineers, universities. Surely they could manage their currency. They said it in Spain after they discovered the New World. Spain had more gold and silver than any nation in history. Surely infinite precious metals meant infinite wealth. They were wrong every time. The pattern doesn't care about exceptionalism. It doesn't care about technology. It doesn't care about military power or cultural achievements or scientific advancement. The pattern cares about mathematics. And the mathematics are clear. You cannot sustain $318 trillion in debt against $105 trillion in annual economic output. You cannot print currency indefinitely without consequences. You cannot debase money forever and expect it to retain value. These aren't opinions. These aren't predictions. These are mathematical certainties. The laws of economics work like the laws of physics. You can deny them. You can ignore them. You can pass legislation against them. But you cannot break them. And when they reassert themselves, they do so suddenly and without mercy. The Weimar mark collapsed in 10 months. The Roman denarius took 2 centuries, but both ended the same way. Complete currency failure, wealth transfer from paper holders to asset holders. And the people who saw it coming, who positioned themselves in real assets, they survived. Everyone else lost everything. Silver at $32 per ounce is not an investment opportunity. It's not a speculation. It's not a trade. It's insurance against mathematical certainty. It's a hedge against the inevitable resolution of an unpayable debt structure. It's a bet that history doesn't stop being history because we have smartphones and artificial intelligence and complex financial instruments at $30 per ounce, with the gold to silver ratio at 84 to 1, with debt at all-time highs across every category: government, corporate, household, with money printing continuing unabated, with interest rates trapped because raising them would collapse the debt structure, with trust in institutions eroding, with geopolitical tensions rising. With every warning sign flashing red, the risk-reward equation is staggering. The downside is limited. Silver could go to $25, $20, even $15 in a deflationary collapse. You'd lose half your investment in a worst-case scenario. But the upside is not 50%. It's not 100%. Based on historical precedent, based on the pattern, based on what happens every single time a currency collapses, silver could go to $100, $200, $500, perhaps higher if the crisis is severe enough. That's 300% to 500% gains. The asymmetry is profound. And here's what most people don't understand about silver's role in a crisis. During the early stages of a currency collapse, gold moves first. It's the traditional safe haven. Central banks buy it. Large institutions accumulate it. Gold tends to lead. But silver follows with far more violence. Because silver is smaller, the entire silver market is tiny compared to gold. Total above ground silver is worth about $1.4 trillion. Compare that to gold at $12 trillion, or global bonds at $130 trillion, or global stocks at $100 trillion. Silver is a fraction of global wealth. This means when money flows into silver, when investment demand surges, the price moves dramatically. There's not enough supply to absorb large capital inflows without prices spiking. In 2010 and 2011, when investment demand for silver increased during the European debt crisis, the price doubled in 7 months, from $24 to $48. That wasn't a fundamental shortage. That was purely investment demand overwhelming supply. And today, the structural setup is far more extreme. The debt is higher. The money printing is larger. The crisis is global, not regional. And when this breaks, when confidence in paper assets cracks, when the crowd realizes the debt cannot be repaid, capital will flood into hard assets. Gold will rise. But silver will explode. Not gradually, not in an orderly fashion, violently. Because there's not enough physical silver to meet demand at current prices. The market will have to reprice dramatically higher to ration supply. This is how commodities work in shortage situations. The price doesn't inch up, it gaps up until demand is destroyed or new supply emerges. And new supply takes years to develop. The pattern is clear. The mathematics are clear. The historical precedent is clear. We're in the late stages of the largest debt bubble in human history. The resolution is coming. And when it does, silver will not ask your permission to explode. It will simply reprice to reflect reality. Now let me address the obvious objection. What if the government intervenes? What if they change the rules? What if they confiscate precious metals like Roosevelt did with gold in 1933? These are legitimate concerns, and the answers matter. First, government intervention doesn't prevent the pattern from executing. It just changes the timeline and mechanism. Roosevelt confiscated gold in 1933 specifically because gold was the constraint preventing currency debasement. By taking gold and revaluing it from $20.67 to $35 per ounce, the government devalued the dollar by 40% overnight. They needed to do this to inflate away debt from the Great Depression. The confiscation proved gold was valuable. It proved the government feared it. And it proved the government would debase the currency, which is exactly why you hold gold and silver in the first place. Second, silver was not confiscated in 1933, only gold. Why? Because silver was already demonetized by that point. It wasn't a threat to monetary policy. Today, silver is even less likely to be confiscated because it's an industrial metal. Confiscating silver would cripple manufacturing, electronics production, solar panel manufacturing, medical supply chains. The economic damage would be enormous. Third, confiscation doesn't mean you lose. It means you're compensated at the official price. If the government confiscates silver at $32 and then revalues it to $200 for monetary purposes, you're paid $32. You don't participate in the revaluation, but you don't lose your capital. You just miss the upside. And here's the key. The likelihood of confiscation is far lower than the likelihood of currency debasement. Which risk do you want to protect against? The small chance the government confiscates your silver, or the mathematical certainty that $318 trillion in debt will destroy the purchasing power of paper currency? One is possible. The other is inevitable. Rational risk management says you hedge against the certainty, not the possibility. Here's what you need to understand about timing. No one can predict exactly when this breaks. It could be next year, it could be 5 years, it could be 10. But the direction is certain. The debt cannot be repaid. The interest cannot be sustained. The currency will be debased. The only question is how fast. And here's what history shows. These collapses don't happen gradually. They happen suddenly after long periods of apparent stability. Weimar Germany looked stable in 1921. 12 months later, hyperinflation. The Soviet Union looked stable in 1989. 2 years later, it ceased to exist. The 2008 financial crisis looked contained until Lehman Brothers collapsed on a Monday morning, and the entire global financial system nearly died within a week. The pattern is always the same. Stability, 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 then sudden crisis. And when the crisis hits, it's too late to position yourself. The price of silver will have already exploded. The premiums on physical metal will be prohibitive. Availability will be scarce. You'll be trying to buy from dealers who have nothing to sell at any price, or you'll be paying 3 times spot price just to acquire physical possession. The time to position yourself is during the calm, during the period when everyone thinks you're crazy for worrying, during the phase when silver is still cheap, during the window when people are still debating whether this time is different. That window is closing, not because I say so, because the mathematics say so. The debt to GDP ratios are at levels historically associated with crisis. The money supply expansions are unprecedented. The interest payments are approaching unsustainability. The warning signs are everywhere. They're just not being reported on the evening news yet. But they will be. And when they are, it will be too late. Here's what you do. Allocate a portion of your savings to physical silver, not paper silver, not silver ETFs, not silver mining stocks, physical metal that you possess, coins, bars, stored securely. The recommended allocation depends on your risk tolerance and financial situation. Conservative investors might allocate 5 to 10% of their portfolio. Aggressive investors who understand the pattern might go 20 to 30%. The key is to allocate enough that if silver goes to $100 or $200, it materially improves your financial position. But not so much that if I'm wrong and nothing happens, you're devastated. This is insurance. You don't buy fire insurance hoping your house burns down. You buy it so that if it does, you survive financially. Silver is insurance against currency collapse, against government mismanagement, against the mathematical resolution of unpayable debt. And unlike fire insurance, which costs you money every year, silver has a chance of appreciating dramatically while you hold it. That's an extraordinary risk-reward profile. Buy physical metal from reputable dealers. Store it securely. Don't tell people you own it. Don't brag about it. Don't make yourself a target. And then forget about it. Let the pattern execute. Let the mathematics work. Let history repeat. Because it will. It always does. The $318 trillion debt structure will resolve. The currency debasement will accelerate. The crisis will come. And when it does, the people holding real assets will be the only ones who preserve wealth. Everyone else will watch their savings, their pensions, their bonds, their cash, all of it evaporate in real terms, not because of some conspiracy, not because of evil intent, because mathematics demands it, because you cannot owe 3 times more than you produce forever, because the pattern has executed 17 times before, and it's executing again right now. The machine is running. The debt is unpayable. The currency is being debased. The crisis is building. Silver is $30. The question isn't whether this resolves. The question is whether you'll be ready when it does. The pattern doesn't care about your beliefs. It only executes. And right now it's executing. Position yourself accordingly. If you want to understand exactly how the currency system was designed, who built this debt trap, and what specific assets survive when the pattern completes, subscribe right now. The next video breaks down the mechanics of central bank currency creation, why gold reserves are being accumulated at record rates while inflation is called transitory, and the 3 assets that have preserved wealth through every currency collapse in recorded history. This isn't conspiracy. This is pattern recognition. And the pattern is screaming at you right now.